Hello guys, welcome to this YouTube video.
In this YouTube video, me and Nat are going to be talking about different market stages and when not to be placing trades.
So let's get into it. Right guys, so this is AUD USD, and basically what I'm going to be talking about is how some people might get tricked into the market and be placing trades without understanding the bigger picture and without understanding what type of phase the market is in. So just going off this example, we can clearly see, well, that the market is uptrending and we're trading within this ascending channel. And we can see that the market has just had this impulsive move to the upside. And as traders, we should know that the market likes to move in impulses and corrections. So we know that after an impulsive move like this, the market is likely to form some sort of correction. However, what some people might do by just looking at 1 hour market structure, they might see something like this, where they see a double top, a break of a support level in the market, something like this. And then what they see is a breakthrough, and then they see a pullback, and then they see this shift in momentum when we've had dojis, and then we've had a sort of engulfing candle. So some people, with ignoring the market structure, the higher time frame structure, the daily market structure, because let's remember that market structure is bullish at the moment. We're still in bullish market structure. So they're ignoring that, but they're just basically taking into consideration the 1 hour time frame. So let's see what would have happened and where they would have potentially put their targets, maybe down to this low, completely ignoring the ascending channel. So let's just see what would have happened if they looked to enter. Yeah, so pretty much straight away, manipulation in the market, they would have got stopped out. And let's see what would have happened after that. Again, so you can see the market does decide to move a little bit in the direction that you originally planned. But as you can see, the market is very choppy. There are lots of opportunities to get stopped out. Even if you took another entry over here where you got stopped out, probably would have got stopped out again. So you can see that the market is very corrective, and you shouldn't really be taking positions in this type of market condition. You can see the difference between this move here. I'll just highlight it, this one, and you can see the difference between this move here. This one's a lot more choppier, a lot more sideways, and in the direction you want it to move in, it takes a lot longer to get to that position that you want it to get to. So what do you need to do, really? You need to wait for the correction to be over, and you want to be trading in the original direction of the trend. So the way you would do that is you can say that price is potentially trading within this corrective pattern here, like a descending channel, something along those lines. And then what you'd like to do is see a sort of break away from this corrective structure before you start to look for your positions. So let's see what happens. So for me, that's price breaking out of it. So now what we can say is we are potentially forming a inverted head and shoulders pattern. So we've got the left shoulder here, we've got the head, and we've got the right shoulder. So when we start to see this pattern forming, what we're waiting for is a break and retest of the neckline. So let's have a look at this. What happens next? We finally break to the upside. Let's slow it down. So we can see now that we have had our impulse, we've had our correction, and now we've broken away from the correction. We can begin to look for buying positions. So let's have a look at what the 4 hour candle looks like on this. So you can see a strong 4 hour candle closing above the neckline of the inverse head and shoulders pattern. Now we can begin to look for a retest of the neckline to look for our long positions. Let's see what happens with price. So we can see there that we formed a couple dojis, retesting structure, and then we formed this bullish engulfing candle showing that shift in momentum. So that would have been our entry with stop loss below our recent low, and we can look to target potentially the trend line up here, making a 1, 2, 3 minimum risk reward. So let's see what happens if I speed this up. Okay, yeah, so you can see that TP was smashed. So basically, to understand what this video is about, it's just about understanding what type of market conditions you want to be trading in. As you can see, as I was explaining at the start, this type of structure is what you want to be trading in. This type of structure is what you want to be avoiding. And then as you can see, where we actually took our position is very, very similar to this structure here. So that's what you want to be waiting for. And what this is an impulse, correction, continuation. So yeah, that's AUD USD and how you should be avoiding certain trades and then how you should be entering the correct trades.
Right, guys, I'm going to be talking about this market condition, and this market condition is a range. And basically, I'm just going to talk about the psychology of it and how price moves within a range. So obviously, everyone knows in a range, you have your resistance and you have your support. You can also call this a supply zone and demand zone. And this range is a 600 pip move. So that means price moves from the highs to lows in a 600 pip move. Okay, so yeah, that's the range. So everyone knows supply zone and demand zone. If you haven't, you probably heard of it. So at supply zone, there is lots of it. So there's a lots of price at this. There's lots of people at the market right now at this resistance. So that means price sells at a lower price, because if there's lots of people, that means there's lots of it. So if there's lots of it, you have to sell it off at a lower price. So that's what happens at supply zone. And as you can see at supply zone or resistance level, if I get a brush, price moves very impulsively to the downside. You can see here, quick moves, because people send off quickly, just getting it out. At demand zone, there is demand for it, so people want to buy it at this zone, but at a higher price. As you can see, price is moving upwards. And because of that, you can see price moves very correctively, very slow, because people are scared to really buy at a higher price, because everyone wants to just sell at a higher price, because you can see the impulsive moves, they're more beneficial. And see at the demand price, boom. So within this, it's very, very risky to be taking trades if you don't know what you're doing. So we would recommend, that's how we trade as well, just to not trade anywhere in between a range, because price can reverse at any moment. As you can see here, we hit this supply zone here. Price came and stopped here, but you would expect price to come hit a demand zone. It doesn't, it flies back up, and it could potentially hit stop losses if you try to get in early or you try to get in within the range. So we recommend not to trade within the range. You can, if you can if you want to, but it's at a higher risk, and that's obviously down to you. So what we would recommend how to trade this type of market structure is just wait for a break below, pull back, retest the previous support in this instance, and then look for continuation to the downside. Or if we break to the upside, we will look for a pullback back into the, so we break resistance over a period of time, then we come back, we retest it correctively, and then we look for the impulse away from that. So it'd be impulse, correction, continuation, a bit like what Ant was speaking about in the channel, but in this case, this is a range where price moves sideways and how we trade it. So we wait for the break of it over a period of time, wait for the pullback, and then continuation to the upside. And that is basically how we trade ranges.